this business, my work is based on the trust that my customers give me, and I can't lose this trust. If they ask me to customize something to make it this way or that way, I definitely have to deliver and make it happen.
Well, trust is the foundation of our business. We're not talking about a few thousands of pesos given to us for safekeeping. We're talking about hardworking folks like yourself entrusting with us billions of pesos to manage for them in a good and responsible way.
The challenge is to keep this trust, even though there are so many things that are beyond my control.
Because we need to make our clients' money grow. Like you, we do our research. We look at many factors: the economy, politics, what's going on abroad. All of these things affect business. But we don't want our clients to be left behind. We want to bring you to the forefront of new ideas. We want to bring you to industries that you may have never even thought of investing before. We want to do this for you and bring you to worlds of investing that you may know nothing about.
What is important to you is important to us too. Your values are our values. Clients know that we mean what we say. They have now entrusted ATRAM, a multi-awarded asset management company, with their investments. Each day, we wake up with fresh ambitions, wanting to do what matters to us, for people who matter to us. We do what we have to do. We live for today and work for the future. We are ATRAM. Your future, our present.
Good morning. Thank you for joining us for this week's episode of ATRAM's webinar series. I am Bea Lina Pelaez, Wealth Solutions Manager at ATRAM. We'd like to inform everyone that this webinar is being recorded for dissemination later today and for posting on our social media pages. Additionally, we'd like to encourage everyone to send in their questions. The Q&A button may be found on the lower part of your screens. Philippine markets have turned skittish this week after MECQ was declared anew in Metro Manila and nearby provinces in a surprise move by the government. This was done in an attempt to stem the growing number of COVID-19 cases that were putting to test the healthcare system in the capital. However, this pronouncement raises questions on the economic recovery of the country. Let us now welcome back ATRAM's Chief Investment Officer, Mr. Phillip Hagedorn, who will be speaking about what this means for the economy, as well as the equity and fixed income markets in the Philippines. Welcome back, Phil.
Thank you, Bea. Thank you for that introduction, and I want to welcome everybody today. I wish everybody is healthy and safe. Thanks, Bea, for having us. What we want to do today, and really we're really in breaking news territory, I guess. This morning, the second quarter GDP number was released, and as expected, it was, in my 30 years of experience and work, the worst quarter I've ever seen as far as GDP performance. The number was released at minus 16.5% in the second quarter, and this is slightly below our expectations and well below market expectations, and we'll get into that in a few minutes. What we also want to try and cover today is what we think the recovery strategy should be. Is it too conservative today, or could it be the correct one? That's something we want to review. And finally, I think I want to touch a little bit on multi-asset global investing. If you were on this webinar with the video that we showed earlier on, I think expanding horizons globally has been beneficial to many of our investors. And we want to talk a little bit about that. Not just trying to paint a picture of where our economy is and where we might be headed, but we need to give you some ideas of what opportunities are out there as well. So we'll try and cover a little bit of that at the end of the presentation today. So let me get right into it. Quarterly GDP growth came out at 16.5%. So this is a bit of a busy slide. I'll just walk you through it. The dots on the left there, the orange and red and dark red dots, were the market expectations. The most optimistic forecast was that GDP growth in the second quarter was going to be slightly below 5%, minus 5%. The most pessimistic forecast had GDP growth dropping by about 20%. And the market expectation was for GDP growth to drop 9%. So the numbers come out at 16.5%, well below the market expectation of 9% on average, but close to our estimate of around 13.7% for the second quarter. So the way we approached our view for the second quarter was looking at these different areas that drive the economy on the right side. And you see that areas like consumption, we were well off. We expected contraction of only about 9%, and these numbers are very fresh. They've just come out less than an hour ago, so we're still analyzing and absorbing a lot of the data, but these are the initial numbers that we're able to share with you. Consumption did contract by 16% versus our expectation of minus 9%. Investment spending, in other words, the corporates and government spending, primarily contracted close to our number. We expected a contraction of about 44%. Investment spending contracted by slightly higher at 53%. We were almost spot on the manufacturing expectations. We expected a decline of 20%, and it actually declined 21%. But services and consumption, these are the largest parts of the economy. This is 60% of the economy, and these are the ones that where we missed quite a bit. We expected just a contraction of 10%, while we saw about 16% contraction in services as well. So all in all, the actual number came out slightly below where we expected, but well below where the market expected. Transportation, tourism, and retail were the worst hit. Now, I want to link up now these big misses, both services and consumption, with what we feel is the biggest challenge the government has today. And that's on the next slide. The biggest challenge is to flatten this unemployment curve. Not only just flatten it, but bring it back down. This is the reason why consumption is weak. This is the main reason. People are losing their jobs, losing their income, and consumption has practically come to a halt. Not a halt, but slowed down significantly. And we feel that the two solutions here to flatten this curve, at least at the start, and later reduce it, is one, that the government needs to provide ample liquidity. The system needs to provide ample liquidity for financial markets, for corporates to be able to borrow, for small businesses to have capital to continue to operate, and interest rates to remain low as well. So the burden is not too heavy. But second, and probably more important, is that we need to get folks' confidence back up, both the consumer confidence and business confidence. In other words, we want corporates to start thinking about capex again. But it's very hard for the corporates to do that if the consumer confidence is very low. So these are two key areas that need to be addressed in the short term for any economic recovery to continue. And I go back to the previous slide for a second. We do have an outlook of an improving GDP number. As you can see, in the third quarter, our expectation is to move from minus 13.7% to minus 7.6%. And then in the fourth quarter, recovering to just minus 2%, and finally seeing growth again starting in 2021. So for this outlook to be maintained, the points I raised earlier, so if you can go back to the next slide, these two factors, together with a third factor, which is obviously the policy implementation of quarantine, which we'll discuss later, is a third factor that needs to be addressed for our forecasts to even come close to being realized. I think that's, we're really at the fork in the road here, and this next 30 days is going to be critical to see whether we have to adjust our forecasts downwards. I don't think we'll be adjusting them more optimistically, but if we were to just be able to maintain our forecast, that would be a good thing. So the next slide talks a little bit about liquidity. Well, before that, the total package, right? We have a total stimulus package. Sorry, we can go on to the next slide. The total stimulus package that is being offered, that's been proposed out there, is a total of about 2.6 trillion pesos. This is a very substantial amount. In terms of percent to GDP, it's substantial. The challenge is not everything has been approved. Not everything is done yet. So if you look at the chart on the left, Bayanihan 1, it's in black. That's because that's done. It's complete. It has been spent. And what we're looking for now is Bayanihan 2 to come in, the monetary support, and create, which are all DOF supported initiatives. So the dark blue is DOF supported, and the light blue is what is looking to be passed now as laws in Congress. No? If you're to add all of this up, it's 2.6 trillion. It's plenty of money. So far, monetary stimulus, in other words, the amount that's been used to support businesses, monetary stimulus does not mean the money goes directly to the people. This is here to stimulate markets, to stimulate liquidity, keeping interest rates low, reserve requirements low. The total is about 976 billion pesos, of which about 2/3 of it has been done already. 650 billion has been done. The balance of 326 billion is what's yet to come, and that's what we're looking forward to. The direct stimulus is probably more important to address the consumer confidence situation. And that's a total of about 1.6 trillion that's being proposed. So far, only 400 billion has been done. So there's a big balance that remains to be done here that is a combination of the different bills that are being proposed. But we feel the time is now. We cannot wait much longer before this stimulus is released. If not, certainly our forecast and outlook for the balance of the year will become more bearish. So I go to the first issue on monetary stimulus on the next slide. You'll see how much has been done. I mean, I think the monetary support is almost complete. It's the Arise and Guide bills that have to be passed. The BSP has injected quite a bit of liquidity via bond buybacks, the reserve requirement cuts, the policy cuts we've had so far, and even global bond issuances, which have gone very positively for the Philippines. We've raised quite a bit of money at a very good rate. And I think there's not much more in the short term that the BSP can do. We also need to prepare for loan guarantees and capital infusions, particularly for Land Bank, Phil Guarantee, and DBP. How this is executed is still a big question mark. You know, small businesses need money, but how they get the money and how the government financial institutions are going to execute this is still a big question mark. So we hope that once these bills are passed, many of these questions are answered and are clear. On the next slide, we address a little bit more the consumer confidence and business confidence issue. This was primarily addressed by Bayanihan 1 initially, but most of the stimulus for this has to come from bills that have yet to pass. This includes wage subsidies, spending for health, tax breaks, lower rates for reinvestment, industry and sector support, support for infrastructure, build, and reallocation. I think one good bit of good news we got this week was that the budget for 2021 has been passed. So again, that's something out of the way. But like I said earlier, I think 1.2 trillion of 1.6 trillion direct fiscal stimulus has yet to be passed. And the longer this takes to get through, you know, the more the economy is going to feel the pain. I am optimistic. I'm being optimistic that we will settle this month in August. And if that happens, then I think the sentiment will turn a little bit more positive about things moving forward. So maybe the next slide, we can touch a little bit about you know, what these things what needs to happen. First of all, you know, the economy is where it is primarily because of a policy, and the policy is called quarantine. The minute this policy becomes more liberal, I think we can see hope and change. It was clear in the months of May and June, even July, that we saw increased traffic, increased foot traffic, increased movement, increased demand as we opened up. I think we have to be very clear. Excuse me. I think come middle of August, when we hopefully open up to GCQ once again, I really look forward to having very clear guidelines as to how the economy will continue to open up. I'm hopeful that we will have that direction. And maybe saying a bit is being, you know, I just like to see some clear direction there. Of the total stimulus that's still yet to pass, we don't need all of it to pass either. I think we're with about 800 billion pesos minimum. We think that will be sufficient to change sentiment. So again, how these bills are passed is going to be very important. Where the money goes also is important. We want it to go to the people that need it the most, that will spend it, because that's going to enhance the consumption. It cannot, you know, leakage is going to be high. We saw that earlier. We want the multiplier effect of this stimulus to be high. In other words, if you receive the stimulus and just put it in your bank account, it's not as efficient as it should be. So, you know, we want it to go to supporting businesses, to keep on paying people and hiring people, and at the same time, bring a boost to spending. We expect the monetary stimulus as well to be big enough to really incentivize the banks to start lending. It's useless to have a bill to give money to the banks to lend to SMEs, and the banks don't do that because of very high credit standards and that ability to release the funding. So again, the ability to execute is going to be very key, which we haven't really seen, and we're relying on a lot of this to be able to keep that view that the economy can recover in a stable way over the next 3-4 quarters, where by 2021 we're back in some sort of growth mode. Another key part of this is for the private sector to be able to start planning and spending. The private sector will not spend without the lead of the government. And so, opening up the economy, getting budget spent, getting build back on track, the infrastructure program back on track. This is where a lot of jobs have been lost and can be created again. But clearly the private sector will not be the first to move. So again, we're looking for the government to take the lead on this. So having said that, there's a lot to be done. Again, I say that we are holding pat on our forecast as of today. Seeing the numbers that have come out, we feel that, we need to review. We will probably have a deeper look at that consumption number, because recovering from that deep drop of minus 16% in this quarter will be a challenge for sure. And how that will impact our outlook for the second half of the year. The numbers are very fresh, so we're likely to have some review and some changes. Again, I also look forward to the next 2 weeks as far as news with regards to policy change and clearer guidelines with regards to opening up the economy and how we will do it, wherein we don't have to go this back and forth to very strict and then unstrict quarantine. And finally, Congress working double time on getting the stimulus packages passed so we can start to reverse the negative consumer sentiment that is out there today. So certainly not out of the woods. I think we're having a better feel of how companies are doing. Maybe in the next couple of webinars, maybe by next week, we'll be able to report to you what the second half or second quarter, first half earnings have looked like. I'll give you some tidbits, but so far the number reported, we're having earnings down something like 70%, with about 48% of the index market cap reporting already. So still about just half of the companies reporting, so we'll wait for the other half to give you the clearer picture. We did have an outlook this year of earnings dropping almost 30%. So again, we can report to you all in the next couple of weeks how our outlook for earnings stacks up versus the actuals once the data is complete. So maybe at this point, before I get into our global multi-asset, we could tackle some questions. I don't know, Bea or Paolo, if there are questions out there on the economy, we can tackle that, and then I can touch on some good news. I want to end on a positive note with our global multi-asset strategies. Any questions that are out there that we can tackle now?
Hi, Phil. So far, no questions for now. I think everything's been very clear so far.
Okay. Well, like I said, I want to end on a higher note. I know there's a lot to absorb today. And many hurdles over the next few weeks, but again, we look forward to challenging and tackling those hurdles and moving forward. But in the meantime, I want to talk a little bit about our global multi-asset strategies. We launched, maybe the next slide, we launched managing global multi-asset strategies almost 10 years ago. And, giving Filipinos the chance to diversify globally. The Philippines is still near and dear to our heart as far as strategy is concerned. So in our ATRAM multi-asset strategies, the Philippines still plays a big part. We are over 50% of our moderate risk strategy for global multi-asset. So you may or may not know the Philippines is less than 1% of global markets. So having a 50% weight in the Philippines in our global multi-asset strategy obviously has a big Philippine component to it, but because we are Filipinos, we recognize that a big part of your portfolio should still be in the Philippines. Today we have a view, and we're overweight the Philippine fixed income space. We'll talk a little bit about this in the next couple of slides. We think there's good money to be made still there. The returns have been good in Philippine fixed income this year, close to 10% if I'm not mistaken. And we still feel that there's more room to make money. Our slight underweight in Philippine equities is a recent move. So we're not completely out of Philippine equities. We're not super bearish. We're just taking a bit of a defensive stance over these next couple of weeks. My sense is that if we see the moves in the right direction with regards to fiscal stimulus and policy change, then possibly going back to neutral Philippine equities is a likelihood. And then we maintain a neutral exposure to global fixed income and global equities. No? On the global fixed income side, we've been focused more on sovereign credits, so looking at countries with good credit ratings and fair yield, and US dollar credit as well, primarily. Interestingly enough, on the global equity space, we're looking at sectors. We've invested in sectors such as tech, ESG, healthcare, and Asia. And we're able to diversify within these sectors to achieve the returns that we've gotten so far this year. No? So I think, again, referring to our video we showed earlier before the webinar, being able to offer very strategic investment opportunities in sectors that we feel will be growing and not just in the short term, but in the medium and long term, is really exciting for us as well. No? So putting this all together in a strategy, I want to show you our longest standing strategy, the next slide. This is our global multi-asset segregated portfolio. It's not a fund. This is an account at ATR Asset Management that is globally invested. The strategic asset allocation is 45% global, 55% Philippines, 40% equity, 60% fixed income. And that portfolio has performed quite well. So including the massive volatility that we've seen this year, the portfolio is actually up this year 1%, which for a balanced portfolio of equities and fixed income, we're quite happy with. And it's given a compounded annual return of about 5% since inception, including this massive volatility that we're seeing this year. So quite stable returns. You can see how the returns have come through the years and how it's diversified across many different asset classes, locally and globally. What we do want to announce is that we have launched a fund that will give you this feel. It's not exactly this asset allocation yet. It will be working towards that. But today we can show the next slide. The next slide is our global multi-asset fund, which is the ATRAM Unicap Diversified Growth Fund. It has a strategic asset allocation today of 80% Philippines, 20% global, but soon that will go with a more global strategic asset allocation once regulators approve the new prospectus. But again, this portfolio has performed well, being diversified globally. Year to date, it's slightly down about 4%. But if you compare that to a pure Philippine balance fund, the pure Philippine balance funds would be down around 7.5% as of July. So again, adding to that global exposure allows you for growth. And I think if I just try to capture how the returns have come, global equities have performed much better than Philippine equities this year. So that's been a help to the portfolio. On the other hand, Philippine fixed income has performed a lot better than global fixed income. And so I think having that mix of different strategies within your portfolio, you know, really reduces the volatility. It actually improves the performance and reduces the risk. And you know, if you're interested in these strategies, please contact your sales folks or our website and have a look, bigger look and deeper look into these strategies. But you know, trying to add some light at the end of the tunnel, the opportunity to invest is still out there, and we just need to open our minds and think more broadly about where to do this. So I'll end my presentation there, and again, if there's questions, be happy to take any online.
Hi, Phil. We do have a bunch of questions. Let's start off with this. Banks have reported that they have suffered losses by buffering for potential loan defaults. Are these just paper losses, or do they mean actual loan defaults?
Well, the technical answer to that is banks can provide in two ways. There's a regulatory requirement of provision, and then there's what they feel they need to provide for potential losses. Very difficult to break it down. So the simple answer there is what is required by regulation cannot be reversed. What they provide on their own may be reversed if they don't come to fruition. So right now it's difficult to tell. I think the banks are being very conservative by providing, which I think is the right thing to do. And if we get some positive surprises, then maybe maybe there's a bit of a change to that in the next few months. But being conservative is what we would expect them to be doing at this point in time. Any other questions there, Bea?
Phil, we have a question here about something that you discussed earlier. Would you have any thoughts on gold, and does it have a place in the global multi-asset portfolios?
Well, we invest in gold via ETF, so technically it's an equity position. So we have a position in gold there in the fund. It's a hedge right now. I mean, I wouldn't put all my money in gold, but I think it's a bit of a hedge against global economies not doing so well. Unfortunately, there seems to be a bit of a disconnect between what markets are saying and what economies are saying. So it's a bit up in the air right now. But using gold as a bit of a hedge to me has been positive this year and useful. We're also moving into a bit of uncharted territory for gold price. So, I think we also be a bit cautious in adding more at this point. We're quite happy with the position we have today.
We have a question here about the PSEI's behavior today. To what would you attribute the market's behavior today? As you mentioned earlier, it's the worst GDP number you have seen, and yet the PCOMP has held.
Sorry, and I am so focused on this webinar, I don't know where the market is right now. So can somebody give me a quick update? Are we up?
Time then, shall we move on to another question?
Well, get that data first, Ben, and then ask me the question in a few minutes. My guess is the market is up. Is it up? I don't know.
So on a more long-term perspective, with a slowdown in the economy and really weak earnings, what will happen to the stock market? And in connection to that, somebody also asked, is now still a good time to invest considering the challenging economic conditions that we're facing?
Yeah, so I guess my guess is correct. The market is up 18 points, slightly higher today. So, you know, what it means maybe is that it's in the price. People expected this number. You know, I know at least the market expected it. So the key though for the future is earnings. You know, if earnings don't recover, the market will not recover. That's a simple rule. And we have to, you know, do the deep dive to each company. What's going to be the impact and what's the road to recovery for earnings for each company? And, you know, I think we have a roadmap in place. Our analysis has a view that consumption needs to return. Remember, 60% of the economy is still consumption. And the stimulus is a key part of this. So, you know, that's going to start the ball rolling together with policy by opening up the economy. So I go back to what I talked about earlier. If our view of minus 20%, 28% or minus 30% earnings growth this year is correct, and we then have a chance of achieving our plus 39% earnings growth forecast for 2021, in other words, we're seeing a recovery of earnings starting next year, then we feel the market has a fair value of above 7,000, placed on a pure PE multiple of between 16 and 17 times. You can pick a number. But if the earnings numbers fail to reach our expectations and move towards our more bear case scenario where earnings drop by 50% or more this year and only recover by 10, 11% next year, then the market will not recover. We're going to be in an L-shaped recovery, and we might find ourselves back to where we saw ourselves in March, you know, in the 4,000 levels. So it's all about earnings in the end of the day. And right now, you know, I think we're, based on the numbers that have been reported so far, about 48% of our companies are below our earnings expectations, 38% are on target, and 15% are above. So still skewing a little bit to the negative here, but we'll wait to see until everybody reports and then share those numbers with you.
Speaking of companies that are under our coverage, someone's asking what we think of the A-REIT IPO and if it's a good strategy to get into.
I mean, A-REIT IPO is now, you know, it's got a yield, expected yield of, for next year at least, assuming they're able to meet their lease requirements 100% and payout. The yield is going to be around the 5.5% range, no, before taxes, which isn't bad nowadays. It's not a bad yield, but it's not a growth stock. Don't expect the stock price to move. I think that is something that we have to kind of, that's our expectation at least. This is not a stock where people would be running into it to buy the yield. In the end of the day, Um, I think lease contracts, although they're there and there are contracts, they're at risk right now. So that's one risk. This REIT does not own any hard property. It just really owns a cash flow. So, your upside is on the back of being able to increase your rental rates. And the outlook for that is not very bright. But the other side of the coin is 5% is not a bad return. So does it have a place in a portfolio when there's volatility? I think so. But is it a growth opportunity compared to some of the blue chips today that have been sold down significantly? That one, I'm not sure. Yeah, I'd rather, if you're looking for growth, there's probably better opportunities out there.
One more question,
Any other
Phil.
questions? I can't believe no one's asking about Jollibee's results.
The question that we have right now, that we'd like to ask right now, is more of on, is there a possibility that we can balance health and the economy bouncing back?
There is, but there needs to be firm leadership, I mean, other countries have done it. We're not alone. We're not the only one going through this. And other countries have done it by opening up the economy. We have to do that. We have to put resources into, if we need to build more bed space. I think the big concern has been about capacity and being able to manage the capacity. That's something that we have the resources in terms of money to do that. I think there's many private sector initiatives that are also looking to assist in that. The healthcare workers, I feel for them, but this is what has to happen: is some leadership, some focus in terms of providing the adequate capacity that we need, and then clear guidelines for opening up. If we require masks, require masks. Require face masks, require face masks. Be strict on implementation, and that way we can open up with more confidence. But we need to also be told of these initiatives and be guided, not just be second guessing and relying on Facebook to tell us what to do.
Phil, lots of clamor about Jollibee now that you've mentioned it.
Well, because the number was pretty significant. They booked a loss of over 10 billion pesos yesterday, right? And a lot of people were shaken. But you have to look deeper into those numbers. 7 billion of it was provided. It's a provision. It's something that they already flagged us. And so the reason I kind of chuckled about it earlier was similar to our market today. Jollibee announced this massive loss yesterday. The stock was at 124, I think. And it closed the day at 131, right? So these are signals that tell me that much of what's out there is priced into this market right now. Can it get worse? Yes. Can it get better? Yes. So I think today I tried to point out what are the factors that can make things get better or make things get worse. And this is what we're looking out for over the next few weeks. So we like Jollibee. We still like it. We think a lot of it's in the price. These provisions were done primarily for their foreign businesses that now seem to be gaining some traction. So we look forward to a recovery for them into next year.
More questions here, Phil. What are our interest rate forecasts for 2021 and 2022?
Well, I think we're flat now, but we're expecting rates to move higher next year again by about 50 basis points in general. That's the view that we have today. We might see rates come off a little bit more today, I won't get into specifics, but in general for next year, our current outlook is that they move up by 50 basis points for next year. So still within a low band with less volatility than we've seen this year.
Going back to the equity markets, someone's asking, with the prolonged quarantine, is there a risk to see a market dip again below the 5,000 levels?
If it goes beyond the 16th or 15th of this month, I would say yes. If there's no clear guidelines for opening up, yes, we will see it go below where we are today. We will see it go below probably 5,000. If we get clear guidelines on opening up and we open and we get the fiscal stimulus, I don't think we'll see the market below 5,000 anymore.
Okay.
That's a direct answer.
What sectors benefit from the monetary policies when business loan rates are still the same? And are banks hesitant to loan out to companies that have inherent default risks?
Sorry, can you repeat again? There's two questions there.
Yes, two questions. What sector benefits from monetary policies when the business loan rates are still the same?
The banks.
Yes, are banks, are we seeing hesitation from banks to loan out to companies that have inherent?
Well, this is the challenge, right? That we know we need to get the money flowing. The guarantees, the government guarantees are going to be key for this. So, this is the challenge that we're faced with today. Sectors, clearly there are sectors that are most affected. We know which those are: retail, tourism. Food is still the least affected. But everybody will be affected if there's no flow of the money in the end of the day, because that unemployment number will continue to move up, and the economy will continue to struggle to grow. So guarantees, that's what we need. Government guarantees, and these packages to pass.
Phil, we have a question here on what emerging markets do you think should we invest in?
Well, right now we're really still when you look at our global portfolios, we're not looking so much at geographies right now and emerging markets versus developed markets. We've shifted our focus to sectors. So tech, healthcare, and ESG. ESG is an important investment strategy. I'm not sure if the body is familiar with what ESG is. That's environmental, social, and governance factor investing. These are good corporate citizens. And so the only area of the world that we're looking at for growth right now is Asia still. So focus on Asia for any emerging market exposure. But we have the ability to be very selective on sectors. And in tech, it's been a great sector for us this year. That fund is making money. It's up this year. This is broad tech. This is the infrastructure of technology. Healthcare is going to be a very important sector where a lot of money will be flowing towards over the next few years, not just because of this crisis, but what the crisis has brought up in the shortages and in the shortfalls of economies and countries in health spending. I believe in the Arise budget, there's more budget allocated to the Department of Tourism than there is to health. Figure that. So healthcare spending will go up. We think healthcare is a good spot. And And then, of course, Asia still is the growth area of the world.
Okay, we actually have a lot more questions, but I think that's the time that we have for today. So I think that wraps up today's session. Thank you, Phil, and thank you to our.
Thank you, Bea.
Thank you.
Thank you, everyone. I hope everybody stays safe. We are still in a health crisis, so be careful and stay safe and keep your family safe. And I hope we all can get out of this sooner rather than later. Thank you, everybody, for joining us today.
Again, thank you to our audience. If you have any further questions or would like to learn more about ATRAM's funds and strategies, please get in touch with your relevant ATRAM relationship manager or visit our website at www.atram.com.ph. Lastly, please answer the survey at the end of this session, as your feedback is important to us. We appreciate the time you've taken to join us today, and on behalf of ATRAM, I would like to wish for the safety of you and your family. Best of luck, thank you very much, and have a wonderful day.